Yeah, Kelly, it's certainly been an amazing ride up. I'm trying not to read too much into this pullback, though. I'm trying not to watch. We don't think it's anything to be overly concerned with. And Michael, you might find this interesting. To get some context, let's compare to 2000 tech bubble. And I'm hesitant to do that for several reasons. But if we're expect a similar reaction, I like to look at an indicator that measures volatility, so month-over-month range in the NASDAQ. And currently, if we look at the last 20 months, high to low range, we're getting about 9% high to low. If you look back to the 2000 NASDAQ, granted it was a different NASDAQ, it was about 15% high to low before we eventually rolled over there in March. So there was a lot more investor motion driving those prices compared to today. So valuations aside, I would say we're not overly euphoric here. We're still a ways away from being overbought in terms of range expansion within the bull market. And the last thing I would say, if I can go to the S&P quickly, we're seeing an expanding volatility correction. We're getting higher highs, lower lows. That correction began back in January 2018. Technically, we're not out of consolidation in the S&P. That would be a monthly close above 3,600, and then you would technically say that the uptrend is back in place. So remaining cautiously optimistic.
Mike, I mean, are there kind of analogies to what we're going through? The one that kind of comes to mind is January 2018.
Yeah, there are certain attributes of this instance and that one that do seem to rhyme. I mean, just essentially the aggressive overbought condition, as you mentioned. I mean, and the real high momentum and persistence of the rally that led to the highs. And some investor sentiment measures are also linking up with that period. Although I would actually have to say that there's a little more of a vein of caution currently among longer-term investors than there was back in 2018. Because if you remember, 2018 was very much everybody embraced this very happy bull story about the economic expansion, about the fact that we just had passed a tax cut and it was going to be 20% earnings growth. And this is different. This is actually the market saying, racing ahead of people's perceptions of how strong it ought to be. So I do think that maybe some of the field position characteristics are similar now versus then, but not sure it has to be a similar outcome, although that was basically just a very, very quick vertical correction and then a long sideways period in 2018 for a while.
So let's talk specifically, Todd, about Apple, which is one of the worst performers today, although I should say one of the most important bad performers percentage-wise. Obviously, there's companies doing a lot worse, but few matter more than Apple. What is this action telling you?
Yeah, I mean, there's obviously big moves in Apple going into and after the split. I mean, we are long Apple in all three of our strategies here at Ascent. We remain bullish. To talk fundamentals at 125, I don't want to know what it is now, but that's roughly 32 times forward earnings. It may seem expensive, and here's some more history, which I think is interesting. The last time from a valuation point of view was this expensive, 2007, ahead of their first iPhone launch, and then they had like almost 45% revenue growth over the next 5 years. So we could be going into this new cycle with the new 5G iPhone 12. Earnings per share is expected to grow 20% next year. So on the chart, if I could do that quickly, we've been well contained in a parallel channel since the March lows. We did meet resistance following the split, so support is viewed back down at about the $115 zone. From our point of view, I would say that support is still intact well above 115.